For years, we were told a simple story. China would never allow its currency to rise, not meaningfully, not when its economy was weak, not when exports were doing the heavy lifting. That story is now breaking, quietly at first, in footnotes, in settlement data, in the uneasy language of central bankers and trade officials who no longer sound so certain. The yuan is no longer being pushed down by markets. It is being pushed up by forces China itself created. An export machine running too fast, a surplus growing too large to hide, and a world that is reaching the limit of what it is willing to absorb. This is not a currency story. It is a system story. And if you care about global trade, inflation, jobs, or the next economic shock, you should pay attention now, not later. Stay with me. Because to understand where the yuan is going, we first need to understand why China ended up here at all. The real question is not whether China wants a stronger currency. It is whether China can still avoid one. For more than a decade, Beijing has managed the yuan as a political instrument, not a market price. Stability was the goal. Predictability was the promise. And exports were the payoff. That framework worked until it didn't. China's growth has become dangerously unbalanced. Domestic demand is weak. Household confidence is fragile. Investment returns are falling. So exports stepped in to fill the gap. But when exports deliver a third or more of reported growth, something fundamental breaks. Surpluses stop being a sign of competitiveness and start becoming a signal of distortion. And distortions don't stay local. They show up in trade data, in political backlash, in warnings from partners who can no longer pretend this is sustainable. The yuan now sits at the center of that tension. Undervalued in real terms, politically sensitive in nominal terms, and increasingly impossible to ignore. To see why this pressure is building now, we have to step back and look at how China's post-pandemic model quietly locked itself into this path. To understand how China arrived at this moment, you have to rewind not years, but cycles. After the pandemic, China did not rebound the way many expected. Consumption did not roar back. Confidence did not reset. Instead, caution settled in. Households saved more. Firms invested less. Local governments tightened. And when domestic engines stalled, the system defaulted to what it knew best: exports. A weaker real exchange rate made Chinese goods cheaper. Global demand, still recovering, absorbed them. Factories ran. Volumes surged. On paper, growth returned. But underneath, the imbalance deepened. Because this time, the export boom was not matched by capital leaving the country. China's financial account remained largely closed. Savings stayed trapped inside the system. In earlier cycles, private outflows helped offset trade surpluses. This time, they didn't. That changed everything. When trade surpluses grow faster than capital can escape, pressure doesn't disappear. It accumulates quietly, relentlessly, and sooner or later, it shows up where policymakers least want it to appear. In the currency itself. That brings us to the first real rupture. The moment when markets, not slogans, began testing China's control. The first rupture didn't come with a headline. It came in the data. Foreign exchange settlements began to shift. Month after month, net FX purchases quietly averaged around $30 billion. Not noise, a signal. This was not hot money flooding in through open gates. China's capital account was still closed. Controls were still in place, which made the message more unsettling. Pressure was building inside the system. As the yuan stopped falling and began to crawl upward, China's state banks stepped back into a role they know well. They started accumulating foreign assets again, not as a policy announcement, but as a response. Call it intervention, call it balance sheet management. The effect was the same, roughly $300 billion a year. Large in absolute terms, small still relative to the size of China's economy. And yet, this was the warning flare, because the underlying trade surplus was far larger than what state banks could absorb quietly, which meant the old playbook was being stretched. The message to investors was clear. The yuan is not a one-way bet. But the market heard something else. If authorities are working this hard to say it, the pressure must already be real. That realization leads us deeper into the mechanisms China uses to contain a force that is no longer external, but structural. At the heart of this story is a distinction that sounds technical, but isn't. Nominal exchange rates move in headlines. Real exchange rates move in consequences. China can limit the yuan's nominal rise to 2 or 3% a year. That sounds controlled, responsible, even, but if that pace lags the interest rate gap with the dollar, the real value of the yuan doesn't adjust at all, which means the distortion stays. An undervalued real exchange rate keeps exports cheap, market share keeps rising, the surplus keeps expanding, and the world keeps absorbing the imbalance until it doesn't. This is why warnings from institutions now sound different. The IMF is no longer dismissive. The market is no longer indifferent. What changed wasn't ideology. It was arithmetic. China's surplus is no longer a rounding error. It is approaching levels that strain the system itself. Managing that pressure requires more intervention, not less. More signaling, more state bank absorption. But every layer of control creates a paradox. The harder authorities work to cap appreciation, the more they confirm that appreciation pressure exists. That is the trap. And once a market begins to believe a currency should rise even slowly, the incentives of exporters, traders, and firms start to shift. That shift sets the stage for the next escalation. The second escalation is more dangerous because it feeds on expectation. For years, Chinese firms learned a simple lesson: hold dollars, wait. Depreciation rewarded patience. Uncertainty made hoarding rational. But that logic is cracking. When a currency stops falling and starts edging higher, even slowly, behavior changes. Exporters hedge differently. Traders reposition. And offshore dollars begin to look less like protection and more like missed opportunity. This is where latent pressure becomes kinetic. There is a vast pool of Chinese corporate savings sitting outside the country, built up over years of caution, kept offshore for a reason. If appreciation looks predictable, even grindingly slow, some of that money comes home, and when it does, it doesn't need open capital markets to matter. It adds to demand for the yuan inside a closed system. That is the nightmare scenario for controlled management. Not a sudden flood, but a steady return. Because slow inflows are harder to counter than fast ones. They don't panic. They persist. To prevent that, authorities would need even more intervention, more accumulation, more balance sheet expansion, which raises the stakes from market management to political reaction. Because the world is watching more closely now. Now let's step away from policy rooms and talk about you. Because currency pressure doesn't stay abstract for long. If you work in an export industry, a stronger yuan isn't a chart. It's a margin, a contract, a yub. If appreciation accelerates, costs rise faster than prices. Orders become harder to win. Competition tightens. If appreciation is suppressed, something else happens. Surpluses expand, trade partners push back, tariffs follow. Either way, uncertainty creeps in, and uncertainty changes behavior. Companies delay hiring, workers save instead of spend, households feel stuck again. This is the quiet damage of imbalance. Not a crash, a grind. You don't see it on one bad day. You feel it over years. That's why this debate matters beyond markets. It shapes confidence, opportunity, the sense of whether the future is opening or narrowing. And this is the uncomfortable truth. There is no painless path left, only trade-offs. If this analysis helps you see the system more clearly, stay with me. Because the consequences don't stop at China's borders. They spill outward. When China's surplus grows, the effects don't stay domestic. They travel fast. Every extra container shipped out of China lands somewhere else as pressure. On factories, on wages, on politics. Trade partners feel it first in the data, then in the streets. Imports rise. Local producers struggle. Governments are forced to respond. This is why tolerance is thinning. European leaders are no longer speaking in diplomatic code. Warnings about unbearable imbalances are not rhetorical flourishes. They are signals of policy limits being reached. In the United States, currency has been a sleeping issue but not a dead one. Reports delayed, methodologies under review, attention returning. And once currency enters the political arena, it rarely stays technical. A yuan that remains structurally undervalued invites reaction, tariffs, quotas, industrial policy retaliation. A yuan that rises too fast invites something else: market volatility, capital strain, global repricing. This is the dilemma China now exports to the world. Not instability, but friction. Persistent, cumulative, and history tells us that when trade friction hardens, it reshapes alliances, supply chains, and assumptions that once felt permanent. Which brings us to the final question. What happens next? From here, the future splits not into certainties, but into paths. The first is controlled adjustment. The yuan is allowed to rise slowly, predictably, enough to ease pressure, not enough to shock the system. State banks intervene more. Surpluses shrink only marginally. Tension lingers, but is managed. This is the path of discipline and constant effort. The second path is forced correction. External pressure intensifies. Trade responses escalate. China is pushed politically, not economically, into faster appreciation. Capital moves faster than expected. Control becomes harder to maintain. This is the path of reaction. The third path is the most dangerous. Delay, denial, old slogans repeated too long. The real exchange rate stays misaligned. Surpluses keep growing. Partners stop waiting. Adjustment then comes suddenly, disorderly, through trade conflict, financial stress, or both. None of these paths are painless. All require choice. And the hardest truth is this: the longer the decision is postponed, the fewer good options remain. Which is why this story doesn't end with the yuan. It ends with leadership. For years, China managed its currency by repeating a promise: stability, no one-way bets, control. But systems don't obey slogans. They respond to incentives, to arithmetic, to pressure that builds quietly until it doesn't. The yuan is not rising because China wants it to. It is rising because the world and China's own economy are pushing back. Exports filled a gap that domestic demand could not. Surpluses bought time. Control delayed adjustment. But delay is not resolution. Every month the imbalance persists. The choice becomes harder. More intervention or more appreciation, more friction abroad or more pain at home. This is the real decision ahead. And it will shape more than exchange rates. It will shape trade, jobs, and the rules of the global economy in the years to come. If you found this analysis useful, don't stop here. These pressures don't disappear, they migrate. The next story is already forming. And when it breaks, it won't feel sudden. Only overdue. Stay curious. Stay ahead. And I'll see you in the next one.